Hi friends, welcome back to Murthy Finance Academy. Today we will be discussing a company called Vimta Labs. So, Vim, before we proceed, a quick disclaimer: I am not a SEBI registered analyst. Whatever the companies we are going to discuss are purely for educational purpose. Please do not consider it as a buy or sell recommendation. Now, let us start. Vimta Labs delivered Q3 fiscal 2026 revenue growth of 10.2% year on year by reaching to 1,005 million rupees. But EBITDA and PAT growth stagnated at 0.4% each, heavily weighed down by a 1.6 crore one-time exceptional labor law cost. Operational highlights include the strategic divestment of diagnostics and 80 to 85% of the utilization of the Hyderabad EMI/EMC chamber through core analytical services were hampered by productivity draining facility restructuring delays. The real question: can Vimta successfully bridge the execution gap between its legacy testing business and the high stake 50L biologics pivot while management effectively walks back its ambitious 500 crore revenue vision? So, the Indian Testing, Inspection and Certification (TIC) industry is shifting from a commodity compliance model to a high complexity research partner model. Vimta Labs, a 41-year veteran, is currently attempting to shed its image as a traditional testing house to become a sophisticated contract research development and manufacturing organization (CRDMO). The August 2024 exit from the unorganized diagnostic segment wasn't necessary if late admission that the company's future lies in high barrier institutional services rather than retail labs. While growth CROs dominate the top tier, Vimta's strategy relies on deep moat, regulatory domain proficiency, and localized physical infrastructure. However, the move into complex research shifts the risk profile from simple volume based lab work to high stakes project execution. So, the company, which incorporated in 1984, Vimta Labs represents one of India's most diversified scientific service providers. So, the company is headquartered in Hyderabad with over 6 lakh square feet of ultra modern lab space. So, company operates as a contract research and testing organization (CRTO) across pharma, food, electronics, and environmental sectors. So if you see the revenue mix, it is primarily dominated by pharmaceutical and food testing, with the remaining which remain the foundational cash flows for this company. So Vimta's competitive edge is anchored by 41 plus years of scientific domain proficiency and a vast portfolio of NABL accreditations. The entry barrier is not just the ultra modern lab spaces, but the multidisciplinary team of 1300 plus scientists. This creates a high switching cost for institutional clients who rely on Vimta's historical data and regulatory track record. So the market is currently mispricing Vimta by focusing on near-term margin stagnation, ignoring the fundamental shift in revenue quality. The company is transitioning from a volume play, which is basic testing, to a mix play by including biologics and CDMO, which should eventually lead to structural margin expansion. However, the company is currently in the valley of death for capital efficiency. Management is aggressively reinvesting depreciation into capex, creating a sharp tension between rising facility overheads and stagnant immediate margins. The so what for investors is you are paying for a high performance engine while it is undergoing a mid race overhaul. The Indian TIC and CRO landscape is benefiting from a global flight towards stringent quality norms and a surging domestic wellness sector. The expansion of NABL certification scope acts as a regulatory tailwind, forcing smaller, unorganized players out and consolidating demand toward veterans like Vimta. So the environment is conducive to growth, but the expansion into electronics and defense testing creates logistical moats. Unlike pharma samples, heavy hardware like drones or EVs cannot be easily shipped across the country. This requires localized laboratories. Vinta's Hyderabad facility serves as a cluster specific fortress, but the same localized and advantage limits national scalability without significantly more capital heavy site expansions. So, its pharma analytical segment faced unexpected operational challenges and revenue deferment due to facility restructuring. Productivity recovery is the key monitorable here, and its clinical research segment lagging in order booking. As for 20L and 50L pilot scale projects, which represent significantly higher project values than traditional testing. So, Vimta's financials this quarter require normalization to see the true health of the core. While the reported EBITDA margin was 34.3%, this included a 1.6 crore exceptional hit due to the implementation of new labor laws in November 2026. Stripping this one-time cost out, margins would have been closer to 35.8%, reflecting more resilient underlying operations than headline suggests. So the balance sheet remains pristine at net debt free with 666 million in cash and cash equivalents. However, the math on management's 500 crore vision is looking increasingly strained. With 9 months revenue at 3043 million, the company needs 1957 million in Q4 to hit the target, nearly double the current quarterly run rate of around 1000 million. Even the MD admitted on the call that they may not touch the 125 crore quarterly run rate target, signaling a significant execution gap. So Vimta is essentially a cash flow positive business with 0.01 times debt to equity, using internal accruals to fund a high risk pivot. While 9 months PAT grew 16.4% year on year, the ROCE dipped to 16% from 2023 in fiscal year 2025, reflects a temporary capital efficiency drag as Biologics capex stays in work in progress mode. So the company's con call highlights on operational delays. They are saying that this code for vendor and contract management issues. For an analyst, this flags a potential bottleneck for the Q1 fiscal year 2027 Biologics launch if facility readiness is tied to external contractors. On the 500 crore vision, this is a soft walk back on the long-term target. Management is prioritizing not disappointing over hitting the specific mathematical milestone, shifting focus to fiscal year 2027. So on Biologics technical scale, the company is all the way up to the process, but the pilot scale development from 20L to 50L, as the scale increases, the project value also increases. So here, the move from characterization to process development is where the margin expansion lies. And coming to its technology, the digital transformation team is now 5 years deep, using AI-enabled technologies from vendors to offset rising manpower costs. And some management is pivoting a 41-year-old testing culture into a development culture. While their transparency regarding the 125 crore run rate miss is refreshing, the dependency on external sources for facility expansion suggests a lack of total control over their own scale-up timeline. Coming to KPIs, its 9 months return on equity is around 13% and ROC is at around 16%, which is a sharp drop because of a WIP capex for Biologics. And its debt to equity ratio is also healthy at 0.01 point. And coming to its asset turnover, which got suppressed due to 727 million capex against 3043 millions for 9 months revenue. And its export revenue also 39% of total income, with 60% of that originating from the US market, making FDA and US regulatory dynamics a key monitorable. So coming to valuation, with a market cap of around 2,700 crores to 1,900 to 2,700 crores, and with an EPS of nearly 12, the market is pricing the hope of the Biologics pivot. In a bear case scenario, if it is continued operational friction in pharma leads to further revenue deferment, and Biologics commercialization sees technical teething issues, keeping margins sub 34%. In a base case scenario, if it is successful in Q4 seasonal surge in food, Biologics commercializes on time in Q1 fiscal 2027 with 2 to 3 anchor clients, EBITDA margins can stabilize at around 35%. In a bull case scenario, if there is a rapid scale of up to 50L pilot scale projects, defense con sector OEM traction accelerates, pharma analytical productivity rebounds, pushing margins back to the 37% plus historical peak. So the stock is fairly priced if you view it as a stagnant testing lab. However, it is an attractive buy the transformation play if the 50L biologic pivot yields high margin contracts in fiscal year 2027. Investors are paying a premium for execution that hasn't fully materialized yet. And what are the some key risks which I found in this company are attrition. Attrition is quite high and is now the norm. Losing key scientific talent during a technical pivot from lab scale to pilot scale is a terminal risk. And second risk is execution risk. Moving to 20L to 50L pilot scale is a massive jump. Any failure in process development could damage the reputation management is trying to build. And third risk is concentration risk. The electronic segment is overly dependent on the Hyderabad defense cluster. Without geographic lab expansion, growth will hit a ceiling. And the last risk which I found is recovery, resolution of the restructuring delays in pharma analytical. And the fifth one is marketing ROI, effectiveness of increased overseas marketing efforts on the other expenses line. And what is the final verdict if you ask me? Vimta Labs is a high performance engine undergoing a mid race overhaul. The full case is anchored by a net debt free balance sheet and 41-year scientific legacy being pivoted toward high margin biologics and defense testing. However, the operational friction and the 1.6 crore labor law impact this quarter serve as a stark reminder that laboratory scale ups are rarely linear. The science is sound, but the near term investment cycle and execution bottlenecks are currently dragging on the valuation multiple. Investors are essentially funding a biologics future with a core analytical business that is currently struggling with its own growth pains. At current levels, Vimta is an execution story, not a valuation story. Hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.